No crime, no charge. You kept every deposit under $10,000, and the government took your account anyway. For 38 years, a small cash restaurant sat off the lakes country of northwest Iowa. Mrs. Ladies. A woman in her late 60s ran it 6 days a week. She worked the kitchen, rang the register, and carried the day's money to the bank herself. She was not hiding anything. Every dollar she deposited came from plates she had sold that day. What the government did to her should worry anyone who has ever run a small business on cash, because by the end, you will see how easily the same thing could reach you. There is a banking rule almost nobody bothers to explain. If you deposit more than $10,000 in cash, your bank files a single report to the federal government. One form. That is the entire obligation, and it falls on the bank, not on you. The rule came out of a 1970 law written to track organized crime and the dirty money moving through American banks. Cash so tainted that someone had to launder it before it could be spent. It was never aimed at a cash register in a diner. The offense that trapped her was not even part of that original law. It was added 16 years later, in 1986, when Congress made it a separate crime to deliberately split your cash into smaller deposits to keep them under the $10,000 line and dodge that report. The aim was to stop launderers from tiptoeing under the threshold. What it produced, decades later, was a rule that could be pointed at anyone whose deposits happened to be small. That new crime has a name, structuring, and the name inverts what you think a crime is. The law does not only watch the large deposits, it watches you for staying small, and it decides on its own what a pattern of small deposits means, long before it asks you a single question and long before anyone thinks to ask whether it should be watching you at all. That last question, whether the government should be watching an ordinary cash business in the first place, is one almost no one in power stops to ask, and it hangs over everything that follows. That rule asks something strange of an ordinary person. To stay on the right side of it, you would first have to know the reporting threshold exists, and then know that trying to stay beneath it is itself the offense. Most people who run a small cash business know neither. They only know that a stack of cash needs to get to the bank, and that some weeks are busier than others. To an investigator reading a bank printout months later, that ordinary rhythm, a good Saturday, a slow Tuesday, a deposit here, a smaller one there, can be made to look like a plan. And once it looks like a plan, the burden of proving that it was not lands on the person who made the deposits. She had kept her deposits under $10,000 for years. By her own account, the habit came from her mother, who had once kept the books, and who told her to stay under the line and skip the extra bank paperwork. She has said she never knew banks reported large deposits at all. Whether anyone in the government would believe that was, it turned out, entirely out of her hands. For most of those 38 years, none of this touched her. The reports, the thresholds, the statute with its section number, all of it ran quietly behind every cash deposit in the country. She made food, she took in cash, she banked it. The law was watching the entire time. She simply had no idea it had started watching her. In 2013, without a warning she could see coming, the government emptied the restaurant's checking account, every cent of it. $32,820.56 gone in a single legal stroke. Picture your own account for a moment. You go to pay a supplier and the balance is not low. It is not overdrawn. It is seized. She was never charged with a crime. Not money laundering, not tax evasion. No allegation that she had done anything with the money except earn it, one plate at a time, and the bills still came. The food still had to be bought. Her savings were locked inside a legal case with a name that tells you almost everything you need to know. The case was not called the United States versus Carole Hinders. It was called the United States versus $32,820.56. That bears repeating because it is the strangest sentence in this story. The government was not prosecuting her, it was prosecuting her money. This is civil forfeiture, and it runs backwards from everything you assume about how the law works. In a criminal court, the government has to prove you guilty, and you are presumed innocent until it does. Here, the money itself was treated as guilty, and it was on her to prove that it was innocent. It is an inversion of everything the law is supposed to do, and it is where the whole abuse lives. The government does not have to convict you of anything. It only has to hold your money and wait while you spend what you have left at your own expense to claim back what was already yours. The thing it put on trial was a number in a bank ledger. A number cannot testify, and it cannot be found not guilty by a jury. It can only be claimed back by an owner willing to spend more than it might be worth to fight for it. The trap has a simple shape. To fight, you need a lawyer. A lawyer costs money. Your money is the thing the government is holding. So defending yourself means paying, out of whatever you have left, to argue about savings you can no longer touch. Plenty of people in that exact position do the arithmetic and walk away. They let the government keep the cash because fighting for it costs more than the cash is worth. Every time that happens, the seizure becomes permanent without a judge ever ruling on whether a crime occurred. It does not need a conviction. It does not even need a charge. It only needs you to give up. And she was not the only one it was built for. In the years around her case, a government watchdog inside the Treasury would go back and pull the files on these structuring seizures, hundreds of them, and what it found would turn one grandmother's misfortune into a number that indicted the entire practice. That number's coming. For now, back in Iowa. Over roughly a year of her deposits, investigators had gone through her banking and decided the pattern itself was the offense. No theft, no drugs, no victim. A small-town cook who, they said, made her deposits too small, too often. That was the case. The 38 years, the sales rung up one plate at a time. None of it entered into it, because in a case against money, the person barely appears at all. For months, that is roughly where she stood. Her name attached to a case that did not even bear her name, her savings frozen inside it, and no exit that did not cost more than she had. She was not the only person in the country in that exact position. She would turn out to be the one whose story got out. Someone noticed. On the 25th of October, 2014, the New York Times put her on its front page. The headline did the work by itself. Law lets IRS seize accounts on suspicion, no crime required. Overnight, the country was reading about a statute built to catch money launderers turned on a woman who sold Mexican food out of a small building in Iowa. The Institute for Justice, a public interest law firm that fights exactly this kind of case, took her on and demanded the money back. And the case that had moved so confidently against her began, very suddenly, to give ground. Around the same time the pressure was building, the tax agency had signaled a change of its own. Going forward, it would generally stop seizing money in cases like hers, where the cash came from a plainly legal source. About 3 months after her lawyers stepped in, the government moved to dismiss the case and return every dollar it had taken. She won. On paper, she won. But the fine print is where this turns. The government did not dismiss the case by admitting it was wrong. It dismissed the case without prejudice. In plain terms, that means it walked away without conceding a thing, and it kept the right to come back. It did not apologize. It did not say she was innocent. It simply let go and left one question hanging over her. Had she actually beaten them? Or had they just decided she was more trouble than her $32,000 was worth? Those two words, without prejudice, come back later, and they cost her. For a moment, it looked like the system had corrected itself. A newspaper shone a light, a policy changed, the money came home. But what it took to get there is telling. Not a courtroom, not a ruling that she was innocent, a reporter, a front page, and a national audience. A run of luck that almost nobody in her position ever gets. For every account that made the front of the Times, there were others drained without a word, owned by people with no lawyer and no reporter, and no way to make the machinery flinch. An account emptied in silence with no front page to save it could just as easily be yours. And a policy memo is not a law. It is an instruction the agency writes to itself. One it can read narrowly, apply unevenly, or set aside when it decides a case is different. Nobody outside the agency voted on it. Nobody could enforce it. And for a while, seizures like hers kept happening anyway. Which raises the question the front page did not answer. If the memo really changed things, why? You would think that is where it ends. New policy, money return. But a memo is only words on a page, and words on a page do not always reach a case already sitting open in a field office in another part of the country. In Fairmont, North Carolina, a man named Lyndon McClellan ran a country convenience store. The government seized $107,702.66 from him, his entire business account, over the same theory that had been used on Carole. And this is the part that should have been impossible. Even after the policy that was supposed to stop exactly this, the government pressed ahead, refusing to hand the money back long after the memo said cases like his were over. The seizure had come first, and the agency's own change of heart never reached it. 301 deposits. Around $2 million in legitimate sales rung up over 3 years, every one of them under $10,000. His store was the kind of place that runs on small transactions. Gas, cigarettes, lottery tickets, a few dollars at a time, which meant his deposits were naturally unavoidably small. The very shape of an ordinary rural business was what the government read as a scheme. To the government, that pattern was the case exactly as it had been in Iowa. The memo, in other words, had undone nothing already in motion. The money was still gone, now simply held in a new state over a pattern that broke no law. A difference here would come to sting. Two people, McClellan and Carole, caught by the same law making the same argument, that the money was clean and the seizure was wrong. You would expect the law to treat them the same way in the end. It does not, and the reason it does not will land in a few minutes. For Carole, by this point, the fight had already taken its price. According to her lawyers and the reporting on her case, while her money was tied up, she sold Mrs. Ladies, the restaurant she had built over 38 years. The money, when it finally came back to a woman who no longer had the business it had belonged to. You can return a bank balance. You cannot return the years or the thing a person spent them building. And then came the number this whole case had been circling. A federal watchdog inside the Treasury Department pulled the records on these structuring seizures. In a sample of 278 cases where investigators could actually trace where the money came from, 91% of those cases involved money from legal sources. 9 in 10. Ordinary businesses like hers, like McClellan's. Across more than 200 of those cases, the government had taken in around $17 million from people whose money it could not tie to any crime. That number changes what all of this is really about. If 9 of every 10 owners caught in this net turned out to be running clean businesses, then the seizures were not catching criminals who slipped through. The system was working as designed, flagging the pattern, taking the money and waiting to see who could afford to fight back. Carole was not an unlucky exception. She was a representative case. Remember without prejudice? Here is what those 2 words cost her. Because the government had dismissed her case that way, walking off the field instead of admitting it lost, a federal appeals court ruled in 2016 that Carole had not substantially prevailed. In plain terms, it means this: she got her money back, but she was not entitled to her legal fees. She had been forced to spend to defend savings that were hers the entire time, and now she would swallow that cost too. She won and still paid to win. McClellan's case ended the other way. His money was returned, and a judge ordered the government to pay his legal fees, his costs, and interest on top. The justice Carole never got, he did. The same law, the same innocence, opposite endings, decided almost entirely by the procedural wording of how each case was closed. His money came back in the summer of 2015, and the ruling in his favor read almost like an apology the government would never say out loud. And this is not ancient history that got tidied away. The power that reached into her account is still on the books, and the real question it leaves you with is who it reaches for next. By 2015, the pressure had moved to Congress. Lawmakers held hearings on these structuring seizures, and business owners who had lived through them came and testified about what it had done to their companies and their families. The stories landed. It is one thing to read a policy memo. It is another to sit in a hearing room and listen to ordinary people describe having their accounts emptied over deposits that broke no law. And the pressure did not fade when the headlines did. It built. Before the reform, an owner could lose every dollar of working capital and simply wait, sometimes a year or more, while the case ground on. The reform put a clock on the government for the first time. In 2019, it became law. A Reform Act signed that July made the change permanent. From then on, the government could no longer take a legal source account just because the deposits happened to stay under $10,000. And if it does seize an account, the owner now gets a hearing within 30 days instead of being left to twist for a year. It grew out of the fights of business owners who had lived through their own seizures. People who turned the worst year of their lives into a wall standing between that power and yours. As for Carole, by the time the law changed, the business was long gone. She had sold it, her lawyers say, while the case dragged on. Her case, the reporting makes clear, had become one of the stories that put this abuse in front of the country in the first place. She did not get her fees back, and she did not get the business back. What she got is harder to put on a balance sheet. The knowledge that what happened to her had not stayed hidden, and that somewhere in the language of a new federal law was a door being shut so it could not happen to the next person the same way. And that is the uneasy part. The reform that grew out of cases like hers protects you from the exact trap she fell into, and from almost nothing else. That same power, to seize first and force you to fight at your own cost to get your money back, is still on the books, still working, still reaching for someone's account right now. One day on a slow Tuesday you never saw coming, it could be reaching for yours. But the honest ending matters more than the triumphant one. That reform closed one door, it did not close the hallway. The specific trick that trapped Carole, treating small legal deposits as a crime, is off the table now. But civil forfeiture itself, the power to put your property on trial instead of you, is still very much alive in drug cases and highway stops and tax files across the country. The law that took Carole's account was reformed. The idea behind it was not, and it is still out there tonight, working the same way it worked on her, on someone who has no idea to start it. So the next time someone tells you the rules exist to protect you, the sharper question is whose rules, and who decides what your pattern means. Carole followed the rule. The government still emptied her account and locked away a year of her life. She got the money back. By her lawyer's account, she had already sold the restaurant, and she never got the year back. If the machinery running quietly behind your own bank account is worth 20 honest minutes of your attention, then you already understand why this series exists. There is one more account this same power emptied, and that case is the one that finally moved a courtroom. That is next.